G'day, Matthew. Thanks for having me. My name's Chris Stevens. I'm the CEO and Executive Director of Coda Minerals Limited. We're a South Australian-based copper-cobalt-silver explorer. We have a project about 6 hours north of Adelaide, just next to BHP's Carrapateena copper project. We have contained copper equivalent tonnage of over 1 million tonnes. That's about 800,000 tonnes of copper, 30,000 tonnes of cobalt, and about 28 million ounces of silver, primarily in JORC indicator resources. Positive scoping study advancing into PFS, one of the best locations in the world, and a great suite of minerals. So thanks for having me on here.
Chris, good to see you. Quite tiny, certainly for copper and silver.
And silver.
And cobalt.
Yeah.
So it's pretty, I think it's a great time for metals. The world's in a sort of, a bit of turmoil as we try and work out what Mr. Trump is going to do tomorrow. So it's been a while since you've been on. I want to kind of reintroduce the story to the platform because I think there's something good going on here. Let's start with the team. So give us a bit of background on yourself and maybe some of the active team members.
Yeah, so I'm the CEO. I effectively founded the company together with our board, Coda Minerals, named after the Led Zeppelin album behind me. My background's in mineral economics primarily. So I'm an economist originally by training and linguist. I'm weirdly a fluent Mandarin speaker and lived in China for many years. Through that, I got involved with all sorts of offtake agreements, commercial negotiations because of my language and numbers skills, and then trained through sort of private equity into mineral economics. Most of my career has been as a feasibility and M&A and sort of corporate activity specialist. So everything from schemes of arrangement, listings, those sort of things. But again, a lot of time actually at the pointy end of trying to make projects work and making sure that project models are where they should be. So I'm very much in a sweet spot of happiness, the things I've been trained to do and things I enjoy right now at Coda with our sort of post-scoping study, PEA into PFS kind of level project. Exploration manager Matt Weber, again, WA School of Mines trained mineral economist like myself, and very much a sort of a strong academic background, very economic geologist. This is one of those companies where we ask the value of every hole before we drill it or every hole before we think about digging it. And so, again, very feasibility driven. He's a phenomenal chemist, very great knowledge of metallurgy as well. Katrina Cedar, commercial manager. She's a real economist. She actually has a double degree in economics and finance from Edinburgh. Again, very, very much feasibility and economics driven group, but together with Matt's exploration chops as well. The board's really solid board. It's not really a West Perth junior board in the traditional sense. Keith Jones, ex-chair of Deloitte Australia, so office managing partner and then chair of the whole of Deloitte previously. He's also on the board of several mining and exploration companies, but very much a corporate guy, runs a tight ship. One of the things, I always have the Keith.ppt PowerPoint ready on my computer every day he comes in. It's always got the cash flows up to date at all times. So again, a lot of corporate discipline. Robin Marshall, Paul Hallam, both very experienced guys. Paul was one of the founding executives at FMG, formerly on the board of Sandfire, currently on the board of Greatland Gold. Robin, most recent role was as chair of the Goldfields Gruyere Steering Committee. So he chaired the technical committee right through feasibility into production. Robin and Paul alone have put 17 projects into production during their careers. Household name projects like De Cruza, the FMG projects, Greatland, Gruyere. And again, our chief geological advisor, Colin Moorhead, no longer on the board, but still very much involved as my day-to-day geological advisor. Again, very experienced guy. I think he's put 5 or 6 projects into production. So the reason I keep emphasizing this is we are at that feasibility stage. And that's a really important part of what we do is making sure that this moves on, but also that it's a real project and that when it gets into production, and it will, it works. And again, we have a board and a management team that's really aligned to doing that.
Right. And before we kind of get into the projects and the assets, and also I guess a little bit about the market, in terms of the team who look at solving sort of technical problems, you've named a few there already, but what exactly is the brief for them at this kind of feasibility stage?
The original brief, to give you a bit of background of the projects, there are 3 open pits, 2 that really matter. MG14, shallow, high grade, relatively small, recovers beautifully. Windabout, slightly deeper, still over 1% primary copper in the exploration target. Really high cobalt grades as well. And I will emphasize at the start, and I'll probably say this 2 or 3 times, but the cobalt is Carolite. Very much analogous to the DRC's ambient style of cobalt, but also Kupferschiefer. So the deposits that run through sort of Germany into Poland, through Central Europe. So that Carolite mineral is effectively a pure copper cobalt sulfide. So when I talk about copper equivalents, I'm not being naughty. This isn't locked up with iron sulfides. It doesn't need a roaster. It's a very well understood. But going back to the brief, the main deposit, Emmie Bluff, our flagship deposit, 11th largest copper deposit in Australia, according to an Oz Minerals presentation from a few years ago when they were being taken over. So major, pretty much top 10 when you include the other deposits project for copper and contain copper, including, the big producing ones here. It's a flat dipping ore body. Without getting too technical, it's relatively thin. It covers a hugely extensive area. So the main briefs for our consultants, and we've worked with a very well-known group called Mining Plus, the globally huge experience in Africa, huge experience here in Australia. Their brief was make it work. Make sure that this thing, now that we've delivered a resource, we delivered the resource in December 2021, make sure it works on a mining scale. Now, we said originally the brief was find us a nice, simple, vanilla way to do it that's done all over the world, and they did. And our first scoping study was based on that. Then we've gone and looked at what I would say a very obvious thing to do, which is mechanical cutting. And again, I don't want to go too deep too early in the interview, but the brief was like, find the most economic way of doing that. So we have 2 mine plans. They both look phenomenal. They've both been not only put together by Mining Plus, they've been double peer reviewed. I said to Colin before Christmas, find me your grumpiest mining engineer who will tell me everything I don't want to hear and, let them loose on the project. So again, I'm not one of those CEOs that's afraid to let someone really have a crack at breaking it. And just for the avoidance of doubt, he didn't break it at all. It actually helps me sleep well at night knowing this has been double reviewed. On the metallurgy side, again, when we got into this project, low recoveries, challenging, people trying to suppress the cobalt, just a miserable time. And the brief there was, again, get us a flow sheet which works, that's used all over the world, simple flotation into either pressure rocks or Albion, into standard solvent extraction and crystallization for the copper and cobalt. Make it work. Since then, and I generally don't apologize for this, we've released 3 scoping study updates. Some people don't like that, but we are effectively about making this better. Get yourself a good foundation that works technically, then get a little bit more exotic, then start trying new things, and let's see how far we can push this to really drive the economics. And we've driven that to about $1.2 billion pre-tax. For the grown-ups in the room, that's $802 post-tax. Lovely project, qualifies for grants from the Future Made in Australia policy. Battery-grade cobalt sulfate in the world's most stable mining jurisdiction, South Australia, from the world's most renewable grid, which is cool. So I don't know if that answered your brief question, but...
You kind of hit a lot of topics there, but I guess what I'm trying to do is understand how you move from where you are today. Obviously, I think copper's on the up. I'm looking to companies like you to say, how do I insert myself into this new ecosystem that we find ourselves in? You're advanced in terms of the economic study phase, but you're not kind of getting that recognition or reward in the marketplace. What do you think is going on? Is there too much going on? Is it too complicated for people to understand? And, if you could point to, one thing about the way that you go about doing business, say, this is something that you should value. What do you point at?
One of the simplest explanations for why we do trade relatively lower. If you look at an EV over resource or an enterprise value over effectively net asset value backing, and by net NPV backing, the ASX doesn't like you putting out comparisons. We do this all internally. I pulled one up the other day and they were blown away. They're like, who did this for you? It's all done internally. We understand where we sit. It's not woeful, but it is at the lower end of the group, especially against some projects which I personally wouldn't necessarily invest in. There are some also very good copper projects out there, but we are very, you're not allowed to say undervalued. I believe the market isn't properly valuing us. One of the big reasons for this, and this is a painful history, is in June 2021, we hit an IOCG in the basement. Now, bear in mind that Gawler Creighton is not famous for sedimentary copper. You don't expect to find this weird Central European style deposit sitting next to Carrapateena and 15 k's down the road from Oakdown West. They found it in the 70s. So we're the ones that defined this. We sort of said, what can this be? But they found Emmie Bluff, a flagship deposit, in the 70s when they were drilling into the basement looking for IOCGs. Now, they drilled in the wrong spot. The sort of prevailing view back then was you drill right in the guts of the magnetite. Without going into detail, we had a different hypothesis, and it was bang on. We drilled on the edge where the magnetite becomes hematite, so both two types of iron host, and we hit 50 meters of incredible sulfides. We then drilled 23,000 meters, 21 holes, all but 3 of them mineralized. We had major funds come in, Sprott, Regal, all big substantials. They gave us some time. No issues with what they did. They're unashamedly about tier 1 deposits. And after 21 holes, we couldn't kind of demonstrate that was a tier 1 deposit. Now, you got to bear in mind, it took about 50 for Carrapateena to really get understood. So, it was just at the point the COVID hot money came out. So again, without going too much into history and starting to need a therapy session on, exploration, that IOCG so far, and it really is unfinished business, didn't pan out for us. The really weird thing is here, and I cannot think of another company in history that's had this. Sitting above it was an economic project. That's the crazy thing. You've got an IOCG in the basement, 400 meters above it at a relatively shallow, simple mining depth, but still an underground deposit. You've got Emmie Bluff. Now, piece of advice for any industry people watching, before you drill something underneath an economic deposit, decide to give it a different name, because calling one Emmie Bluff and the other one Emmie Bluff Deeps wasn't very smart. It leads to a lot of confusion. So you ask me, what would I change? I would change, look, this is a relatively shallow, simple mining depth. It is absolutely mineable. Mining Plus and Say Plus peer reviews have done a lot of work on this. None of what I'm going to talk about today, none of the economics, none of the resources include that June 2021 hit. But when you had 25% of your register in 3 funds leave the market in less than a 9-month period, you get hit pretty hard. So we've recovered a lot. We've done a lot of rebuilding. Well over a third of our register has no corporate history, no memory of that IOCG. They're all about the sedimentary. But yeah, it's been an interesting ride, and it's certainly led to a lower value per ton of in-ground resource because of that history. If you never had that sell down, you don't get hit.
Right. Okay. Well, okay. So we'll park that history up then, and let's just focus on the current story. The current story needs to operate in the current macro environment for copper, current macro environment for junior equities, which is being hit hard. A lot of people, retail, stepping out of the space. They've not got disposable income, discretionary spend anymore to play this game. So we've seen a lot of companies change their model. And by that, I mean they're having to talk a slightly different game, because investors are nervous about how these things get funded. You talk a big game, you're going to need big money, and that's expensive money. And maybe this isn't not your team, but to say juniors are the boys and girls who can move that forward.
Yeah.
People have said, right, if we are to talk a game of maybe getting into a kind of near-term production type story, that might suit us better. And we've seen the reflection of that last year. That was definitely, companies got rewarded for that. Do you feel you need to kind of change your narrative somewhat? I know you're moving into feasibility stage, and that's great, that's advanced, but does that need to be adapted for current market conditions, given it's it's a significantly retail type story?
Yeah, so there's a few things I think that work. Yeah, I'm really passionate about this space. One day I'm going to write my book, Confessions of a West Perth CEO. There's not going to be a lot to confess, to be honest, but it's a good title. But as a real student of this space, and I often say that if there were more people in this industry with history degrees, we'd have a lot fewer disasters. The current state of the market, really, what does it value? Well, it values big swings. That's one thing in terms of exploration. loves drilling results. Development stories are, for now, their name is mud. People are not really putting their money into development stories. And the macro is scary. I mean, Dr. Copper is called Dr. Copper for a reason. And so, you asked me a question, which is, should we be changing our focus? Well, firstly, I think we have a very solid underlying project. A lot of that is leveraged to future thematics. And we're not talking about multi-billion-dollar CapEx bills either. What we need to do is to demonstrate a clear funding path. And, the funders have been sitting it out right now. And I think the view on the funders is if you wait around a bit longer, it'll get cheaper. And that's not Coda, that's everyone. And we see that. I cannot think of many copper projects that have seen that funding space. So we're talking about well under a sub $500 million US dollar CapEx, well under, including 30% contingency, which no one in our space includes. We're talking about levels which are manageable for many groups, not just the absolute tier ones. In terms of fast startup, we do have a big advantage in that we've got the open pits. That creates revenue as you're going underground. There is limited scope with our project in terms of, for example, long-term concentrate sales, but the early startup really helps. And one of the things we've been doing is looking at exploring for some of the shallower resources and also doing more with the shallower resources so it increases that early startup. So I think that's a really powerful thing. The other area we're focusing on very much at the moment is around the cobalt. Cobalt has often been seen as sort of almost an Achilles heel. It stops you selling a concentrate. It adds, roughly 180, 200 million Aussie dollars to our CapEx bill. The flip side is the Future Made in Australia policy is currently giving us about 25 million back on a post-tax MPV basis. Why juniors talk about pre-tax, I do not know. It's rubbish. It's just to make the bigger number. The one that matters is post-tax, right? It's just silly. The argument is that the majors have a different tax base, so they look at it that way. I'm not sure I'll buy that one. But on the post-tax MPV, you're getting a good $25 million back. That we expect to grow as well when we get more sort of the scope through. Potential access to policy bank funds. We've had a lot of interest and conversations with major groups looking for that ESG focus. And again, going back to the cobalt, DRC has just regulated cobalt exports. We've seen the price increase. I understand that price to be very heavily driven by sort of running certain mines in the DRC quite hot at the moment. The world's foremost experts in this benchmark minerals have quite a strong view that this is a strategy which will not last. We are seeing a massive increase of consciousness in terms of where the minerals that go into things like EVs and even computer and phone batteries come from. So the ability to produce that cobalt in South Australia, the world's most renewable energy grid, wonderfully sort of ESG friendly location, and Elizabeth Creek, even by South Australian standards, is fantastic for that. So again, that conscious things, look, retail shareholders are really looking for sexy drill hits. Or they look at the big swings in terms of drilling. Fast startup, I think, is an option. But demonstrating that funding pathway, again, with a 600 million plus contingency CapEx, Aussie, and again, having the right funding groups, having the right access to policy funding, all phenomenal attributes of this project. Is there a simple 150 mil startup option here? No. Am I aware of any other projects in Australia that really have that either? No. This is one of the interesting things in copper. Those easy oxide heap leaches are fewer and fewer in between. And don't get me wrong, I love projects like Merrimack. Like, great. How did they not find that earlier? I mean, someone just did a cracking job there, right? But, those are rare. And to put it in context, we're talking about the same contained copper tonnage as Elizabeth Creek. But it's a sulfide flotation.
Let's get focused on you and how this moves forward. Maybe what people looking at this story might be focused in on. They're focused on, right, okay, so the market cap is a bit light. You've got cash in the bank, which is good, $4.5 million bucks or something. They're 4.5. Okay, great. So you've got options there in terms of the pace at which you move. I think people will be asking quite rightly, okay, let's talk capital efficiency, capital allocation. What's the right way to move this project forward? How do you fund that? Over what period do you fund that? Are you still going to be around in a year to be able to continue this moving forward? That's a really fair question. A lot of juniors are cash strapped and just paralyzed. So talk about how you view your current cash situation, where you point it, and why that's the best use of that capital.
Yeah, I mean, last time I looked at our cash balance as compared against peers, which was the start of the last quarter, we had more cash than all but about 155 ASX listed companies. Bear in mind, we're sitting at about the midpoint of the 750 in terms of market cap. So really solid cash balance. Some of that is credit to obviously a phenomenal and very supportive top 20, and hugely grateful for their support. We wouldn't be here without that. And again, it's hugely supportive brokers. We started working about 9 months ago with Cumulus Wealth. And again, their support, their belief in the project has been phenomenal. So again, we have and a lot of that's driven by the fact that people know when they put money into Coda that there's an extremely responsible team. I mentioned the Keith.pptx thing that sits on my desktop, but every single person in this company knows that you do not come and ask me for something without bringing the impact to the cash balance and the expected news flow, catalysts, or advancement of the project with it. And so again, a huge amount of discipline. Will we be around in a year's time? Absolutely. I mean, we have more than enough cash to last the next 12 months, even with a reasonably, I hate the word aggressive, but, reasonably aggressive sort of technical program. We're advancing approvals. We're working on metallurgy. We're looking at some geophysics work on some of the deeper stuff. We're looking at a little bit of exploration for some of the some of the deposits around MG14 as well. There's a bit of unfinished business around that. And so that's really big, powerful attribute for the company. So yes, absolutely, we will be around. And not only will we be around, we'll be able to do a fair bit of work along that. Bear in mind, there are 4 full-time members of staff, a part-time CFO, and a couple of one-day-a-week AP people. So the average cost of this company are very, very low.
Right. It's a bit okay. And I want to stick with this because it's really, really important that people kind of get where you're at and where you're going. So we're talking about feasibility phase here. Have you got enough money to get that feasibility study done? And if so, what's the feasibility actually worth to you? A lot of CEOs come on to talk about catalyst moments. Do you think that's a kind of catalyst moment, or is there an actual commercial bottom line value to that for the business, for someone to actually take it and move it forward, or for you to take it and move it forward?
Yeah, I've been reluctant to really push the more sort of expensive bits of feasibility that don't generate big news flow or, in this market. Now, do not take that for a lack of confidence in the project. It's just the reckless, and I think reckless may be the word, but, build it, she'll be right kind of approach is not the right one in this market. There are markets where it would be the right one. And I think if you weren't making hay while the sun shone in 2020 and 2021, you were asleep at the wheel. This is more of a cautious approach. So there are certain things that you can advance. The critical path with these projects is always, without exception, approvals. And you'd be amazed how many teams get that wrong. Remember years ago coming in to try and fix up a study and, they'd forgotten to do the spring survey. It was summer. You've now got 9 months to wait. Don't get that wrong. So there's a lot of stuff like that. We've got dust monitoring on site. Doing those, currently autumn surveys here in the Southern Hemisphere, making sure that's advancing. So approvals, important. We're also making the project better. One of the big swings that we still have, the gas left in the tank here, is reducing that capex. So you asked about fast start and everything else. We put in our last announcement that we are investigating ways to reduce the capex to better get hold of that cobalt. That's a huge part of our focus right now, huge catalyst as well. So what I'm talking about is finding ways to potentially reduce the flotation and potentially also the Albion circuits within that. There's a couple of $100 million in capex there. We've been investigating whole or leach for a very long time. I won't say a lot more than that to make sure I stay this side of the right market rules. But that's been a big focus for us for a while. We're running 2 consecutive pieces of work. One has the potential to just replace the Albion, which would still be enormous. One has the potential to replace flotation and Albion. So again, these are huge swings right now and have the potential to be game-changing for the project. And again, that's a big part of what we're doing. We're also looking at exploration. We just did some. The resource is likely to increase when we start getting the drill rigs out again. Emmie East was a bit disappointing, but Emmie Southeast was fantastic, probably exceeded expectations. So we had a loss and win. Overall, Emmie Southeast sort of is quite proximal to the main deposit. So again, we did a long podcast on this if you want to go and find it, but if you're watching this, but I think that was episode 19 from memory. But, there's some good results there. And then obviously the southern exploration as well.
So you're being careful about how you allocate capital until there's some better sentiment, there's better momentum in the market, and you've kind of focused on those kind of efficiencies. Nothing wrong with that. It's all good stuff. I just want to understand that's the process that you're following. It's not a case of you are restricted in your abilities of what you can do and when you can do it. This is a choice, deliberate choice.
Absolutely. I mean, in a different market, would I like to throw the kitchen sink at every possible opportunity? Of course I would. You very rarely have those markets. And usually, I mean, the miner's prayer, right? Dear Lord, give me another boom. I promise not to squander this one. We saw that happen in that 2021 period. We were less advanced at that time. We were working away at our resource, and we put in a 40 million ton at 1.9% copper equivalent resource. I don't feel we squandered that boom. We did well there. I made the comment earlier, if there were more historians in the industry, we'd all do a lot better. Two things which I know to be absolute fact. The first is that when you get your ducks in a row and you advance your project, that may not be something that the ASX investors will reward you for in the short term. In the longer term, having a shovel-ready project, being ready to move, is everything. And, you often, when things move, the other part of the history is that, the BD managers of this country, whether they're on the funding equity, private equity side, or whether they are on the industry side looking at acquisitions, they're all sitting there waiting. No one wants to be the first mover. And what we see is when markets move, and since Roman times, markets have moved in commodities, and especially recently, we see these macro cycles start. Copper goes into deficit, everyone starts moving, and that's why they always end up paying top dollar at the top of the project. So the more advanced the project, more advanced approvals, the better you're in, the better position you're in. And we have been in this exploration drought for so long now, with copper and cobalt projects so starved of capital. The ones that can survive, the ones that can thrive and keep going will do incredibly well. And that's, as far as I'm concerned, these cycles are an absolute fact, will never change, never have changed. And we are at the bottom of one right now.
We are at the bottom of one right now, for sure. But it's one of those cases of people listening to this or reading about it or listening to it on podcasts, etc. They just want to know that the work that you're doing now, I think you just touched upon it there, saying, look, this kind of sequenced approach to the kind of the flexibility in terms of looking at the numbers, that the kind of sustaining capital costs down the line, these are important now because they allow us to start quicker if we get these things right now. It's a bit boring, if I'm honest.
It is.
For most retail going, I just want drill results. I want high grade copper. I want high grade silver. I want copper. I want it all. But again, do you mind just spending a bit more time just talking about I know you touched on some of the things that you're looking at, but I'm interested in, more importantly, what it does to things like the NPV, what it does to the IRR if you do make these changes now, because the ore body is the ore body, right?
Yes.
So the kind of efficiency, the engineering, the detail is important.
The big swings are obviously in the IOCG. None of that's in the current plan. None of that's in the resource. If we can get a win on that, we're not about to start drilling 1,000-meter holes. Don't panic. But I do believe there's a win there to be had in the medium to longer term. And some of what we can do is obviously generate those targets better. There's new technologies. There's a few things we're looking at. We'll see if that works first. I tend not to promote first and see if it works later. Let's get our ducks in a row there. In terms of the NPV and the major projects, the major parts of the projects that we're working on right now, the NPV impact would likely be pretty substantial. Why? Because anything you can do to reduce capital will always have an outsized, just the basics of discounting, will always have an outsized impact on the NPV, but they will also have an outsized impact on your fundability. And so, I will always take a $100 million reduction in the CapEx over a $200 million increase to the NPV at any stage, because it will always end up better for shareholders. If you can take both, even better. But these CEOs and project managers that just keep making the project bigger and bigger and more expensive, chasing NPV, it never ends well. Eventually someone fires them and they bring someone in who's value focused. And so that's what we're doing right now, is being value focused. Big metallurgical swings. You talked about drilling. There's basically a few reasons why you drill. You drill to make a discovery. We've seen companies even close to us drilling big swings, targets that deserve to get drilled, but then fail. You effectively lose your money. We've had our discovery. We've taken 250,000 tons of copper that we had at listing contained and turned that into nearly 1.1 million tons of contained copper equivalent. So we've had that discovery. That drilling succeeded. We've discovered the IOCG. Admittedly, it's an interesting bit of history if you watch the first part of this interview, but we found that as well. And then we've put mining plans and everything around that. From here, infill drilling is not going to help shareholder value in the short term. Obviously, in the longer term, getting prepared for mining is important. But yeah, drill results are drill results. They're great as a speculation thing, and everyone loves a true discovery. The reality is we've had a true discovery. We're now making sure that this works, and we're trying to bulletproof it, not just at $4 a pound copper, but at $3 a pound copper. And everything we're doing right now is moving us closer to that genuine funding solution and moving it closer to becoming a mine. Is it sexy? It is to me. But I'm a long-term value investor. I believe in the fundamentals of copper, and I believe that buying a project that's currently trading at a massive, plus 95% discount to its net present value, in the long-term copper demand is incredibly sexy, but that's the way I invest. And when I invest in other companies, that's also what I look for, that long-term high-value exposure.
Okay, so I think you gave us a clue there in terms of what possibly to expect from the feasibility study, in the sense that you've told us what you value more, and the work that you're doing is more about the, margin, old-fashioned thing, like making money rather than building big for the sake of big. So do you think, in terms of those sensitivity analysis that you're conscious of, that you're going to be able to kind of, implement those ideas, or is there kind of it's a trade-off with other variables where you're saying, well, we've got to give the market what they want, or we've got to give industry what it wants, or we're going to say, we'll just let the economics stand for themselves, and someone who wants potentially to build a very high margin project that might attract them. So who are you trying to impress or attract?
I think right now it is very difficult to impress many of the retail investors on ASX with development projects, if I'm honest. Maybe too honest, but we can, and we certainly have looked at and continue to look at, for example, whether or not there are other projects proximal to us, or frankly, even in, could be anywhere on the planet, where you can drive some of those discoveries. We're a good exploration team. We've got a good history. My concern always with doing this, I like companies that have a couple of focuses, but I also worry about companies that lose focus on their main project, right? So there are things that we can do in that regard. And again, if we find the right project, we're always going to try and drive shareholder value that way. But fundamentally, if you want to, but that's probably the main way that you see shareholder value driven. A lot of that retail is about that early exploration. Development projects, as I've said a couple of times already, they are not currently popular. But they're not currently popular because of the way that the economy's gone and because of money deserting the sector. As you see market cycles change, and as far as I'm concerned, I was right about what was going to happen in lithium. It sounds arrogant because I've been really bad historically making money personally from this, but I've been very right as an economist. The old joke that economists are very poor at predicting the future and very good at explaining why they didn't think would happen happened. But in this case, Lithium was very obvious. You've got a perfectly elastic supply curve in the long term. Nickel, you could see that happening with the increase in supply. Copper is the same, but in reverse. You can see the supply dwindling. You can see the absolutely inexorable move towards decarbonisation, increased electrification, not just because of decarbonisation, but also because generally electrification, the technology is improving, it's becoming cheaper. And therefore it becomes more sense to, cook food, heat your water, do all these things that way. That uses more copper in a supply demand with copper reducing. Battery storage uses more cobalt. You can see these things happening. So again, probably a long-winded way of saying, I absolutely believe in the value engineering of a project to make it work, to make sure that when it gets mined, it's going to make money. And I believe if you do that, then especially as cycles start to change, you will attract not only funders, but the right type of funders, and you'll be able to create project value that way.
But what do you say to some of your kind of third-party validators in terms of, right, that's my hypothesis, that's my thesis, and this is what I believe will create value in the long run. So when you talk to these groups that are helping you, and they've got to do their kind of trade-off studies for you, what exactly are you getting them to focus on? Do they understand what you're trying to be? Because there's a lot of companies out there who don't talk like you do. They just give me the key. It's really, really kind of simple for them in a way, and I mean simple in a good and a bad way. This is the way we do things. This is the way we've always done things, and this is the way the market expects us to report. Do you think that focusing on these things with these consultants that you use will give you the outcome that you want?
Yes, I do. And I think it's still a very simple way, which is we have a base project. That base project works. The scoping study economics, you can argue the inputs. Our copper price assumption was $4.20 a pound, $9,260 a ton. Copper has barely been below that, even at the most extremes of the last few weeks with the tariffs. And it's been above that for nearly the entirety of that period. 0.68 Aussie FX, and it's now sitting at 0.62. And so, and I'm seeing companies play around with these FXs. The problem is you've still got to buy the equipment from overseas, right? So, we've resisted some of those games, I have to say. But the simple fact is there's a project that works right now, absolutely works. Especially whilst we're being conservative with our capital allocation, we can put in some hard yards work, think better, improve the project further, then I feel that is a very valuable thing to do. And I think if you own a share in Coda, you should feel very comfortable with that strategy. And I think I would buy a share in Coda because of that strategy. This is a project that works. Copper dynamics are where they're at. If you don't believe in the future of copper, I'm probably not sure I'd be playing in any of the junior copper space in Australia for obvious reasons. But the future dynamics of copper are very strong. And again, seeing a project with a very technically driven management team, an approach to continuous improvement will work. And when we talk about funding, I talk to a lot of groups very regularly. I think you can see funding deals. Often the boards incentivize people like me with life-changing sums of money to get a funding deal across the line, and they very, very rarely work well for shareholders. They do a deal. Now, it's not to say that we don't want to do a funding deal. We want to do the right funding deal. And I think with my background in M&A and our chairman's background, we have a big leg up in understanding these things, and we study the history of it as well. We look at what works, what doesn't. But we get taken very seriously. They like our approach. I hear it a lot. You guys, good solid project. The work you've done is exceptional. We believe in this. And I think that's going to be a huge advantage to us as well.
If you look at how companies like you get judged by the market and by industry, right? So the industry is simple. They can get capex intensity and opex and grade and IRR and locational advantages and infrastructure and so forth. That's kind of understood. And I guess to a degree, retail also say, well, is this thing in a place technically? Is it in a place geographically where it's attractive to majors? Now, at the moment, you haven't got the scale to attract the major component, I don't think. But it doesn't matter. It's going to be attractive to someone if you can show that this thing is economic and has got that kind of growth potential. So in terms of that, driving that positioning, do you think for all the things you've talked about today, you are close to a position where you can demonstrate that? Or is this another junior who wants to kind of drill and build this thing out to the edge of the envelope? What is going to work for you, just simply put?
No, I mean, look, in terms of drilling, we've been very conservative about what we've done. And the main drilling I would be focused on going forwards is just around some of the unfinished business. It's very low cost, sort of 15, 20, 30 meters depth, dune sand, very, very low cost stuff. We're certainly not going to be drilling 1,000-meter deep holes. I think Emmie Bluff, we've probably gone as far as we should for now, but that's a major deposit already. It has some extensional potential, or very serious extensional potential based on the last drilling. Amazing location. You're right in terms of the very majors, the BHPs and Rios of this world. They generally are looking at 50 to 100,000 tons production per annum. We're seeing about 35 equivalent, so about 26 copper, 27 copper, and about 1,400 tons of cobalt. But that is still a significant scale. There are many, many mines on this planet that are much smaller than that. That is real, genuine tier 2 rather than a sort of an escondida scale. But one thing I'll point out about copper is 80% of the world's copper is produced by 20 companies. I think 5% of the world's copper, and bear in mind we're talking about a $260 billion US market. It's like 20 lithiums. 5% comes from Escondida. These mines are getting deeper, they're getting lower grade, they're getting mined out. And in a lot of cases, things like Las Bambas, Peru is increasingly challenging to mine with ESG concerns and other things. And, new discoveries just aren't happening. When did you last hear about a great new discovery in copper versus nickel or lithium or rare earths? I mean, which turns out they're not so rare. But, the reality is, and we need rare earths, we need lithium, and I'm not criticizing these markets, but you don't see that in copper. And even when you do, even the really big, cool discoveries are often not that big. 1 million tons contained is a decent size company these days. And when you do, look at Oak Dam West, 8 million ton resource. So that's about 8 times the size of Elizabeth Creek. But it doesn't get good until 1,100 meters. Amazing deposit. But they're getting more challenging. And so the future is going to be increasingly in these smaller deposits, lower capex, easier to get into, and very much part of that future supply. If the world was discovering 5-10 million ton deposits every other month, I would feel differently, but it isn't. And I think that's totally missed by people.
Okay, I'm going to finish off with a sort of section, short, to the point answers, because I want to go away remembering these things. Okay, and this is going to be around kind of the kind of competitive environment for you, right? Can you sort of quantitatively differentiate your metallurgical recoveries, capital efficiencies, your kind of phase development approach, flexibility, compared to, say, some of the other players in Australia? We'll start with Australia. We don't need to name names. I could, but we don't need to name names.
It never goes down well when
no
people like me start going on a rant about how rubbish everyone else's projects are.
Okay,
some are good.
What's the good about you guys versus, say, some of the other Australian copper stories that we look at?
As a comparison with other projects, and again, I'm not someone who will sit here and bag other projects. I'm invested in some other copper projects. Some of my friends run other copper projects. But looking at Elizabeth Creek, there really isn't much I would swap it for. Don't get me wrong, I'd swap it for Kamoa-Kakula. But the reality is that we have very strong economics. We have used very conservative assumptions. We're seeing $10,000 copper used in models consistently, 0.62, 0.65 exchange rates. So NPV, $1.2 billion pre-tax, NPV 7, 802 post-tax. But that's, again, at $4.20 a pound copper, which is, say, the spot price in an incredibly challenging market right now. So the economics are really solid. 1 million tons contained. Sure, there are bigger projects out there, including in Australia, but look at the greys as well. Some of the really large projects that you see kicking around in terms of contained tonnage have a lower head grade going into the mill than our waste dump. This is a very solid 1.9% copper equivalent going effectively into the mill. We will optimize that as well. I'm personally of view there's too many low-grade tons in that, so I'd like to see it go over 2. But that's optimization the next stage. Then, to economics, you've got scale. 27,000 tons of copper, that's serious. 1,300 tons of cobalt. Talk about capital efficiency. $680 roughly million capex with a financing requirement of only about $550 and a startup of $330. Everyone hides their total capex. Grow up. Give everyone the real number. Right? So that's what I've just given you. Look at that capital efficiency. We're talking about multi-billion-dollar capexes in the nickel cobalt projects to get 2,500 tons per annum. We're talking about 1,300 plus tons per annum from a sub $500 million US capex, all in with 30% contingency. Then we'll talk about the intangibles, or the numeric economics related stuff. So you've got good economics, you've got good production. You're in South Australia, tick. Best place in the world to develop a mine. You have some of the best ground. We are on the same ground with the same traditional owners as BHP. Wonderful people. Very commercial, very experienced. We have phenomenal pastoralists in the area. It's single use, very minor sheep grazing. Emmie Bluff, underground, not going to bother anyone. There are no towns nearby. The closest town is the military town of Woomera, and that's a decent distance. But you've got the Stewart Highway running just 10, 15 kilometres from the front door of MG14 and Windabout. You have the major grid capacity going over our tenure. There's a 133 kVA substation on our tenure. There's the Carrapateena Haul Road on our tenure. And the northern water pipeline that they're building right now will literally go past our front door. It'll be a couple of kilometres from the processing plant. So you've got power, you've got water, you've got roads, you've got the BHP Haul Road that runs between MG14 and Windabout. You've got phenomenal traditional owners who understand mining. You've got great land use characteristics. You've got no towns nearby. And you're in South Australia, the only state in Australia that has a sort of one-stop shop right through all approvals, DEM, scoping process. I was there last week. I said, I'm in town. All of the senior people came out for a meeting. Again, superb people, proactive, productive. They hire in management consultants now into strategy because they want to understand this at an industry level. So I could go on, but look,
I get it. So the infrastructure is there, the right place, and you've answered a question I was going to ask you anyway. But I want to finish with this because I think this is the bit that I think some retail struggle with to internalize or even value, right? Yeah. So in technical and economic terms, why do you prefer your kind of systematic multi-deposit approach? And that's the bit that always confuses people. It's like, how do I value this multi-deposit approach over, say, a single asset or a high-grade narrow vein type deposit? That's it. Answer that one. I think you would get a lot of people back in this story.
Interesting. I've never really thought about it that way. I mean, to my view, you've got two really high-quality, high-grade, near-surface open pits. You've got one underground, they're absolutely truckable. I mean, there are other deposits in the region, you can't truck shot rock, right? So forget it. Unless they've got scale for concentrator, you really are in a hub and scope. But these are truckable with shot rock. So they go to one central ore processing facility. So I've always seen it as one project. Yeah, sure, the sedimentary in the ICG is confusing. It confuses me. It confuses everyone. We could talk geology for hours about why it may or may not be there. I promise not to. But the reality is you've got two open pits. They give you fast revenue, startup, keep initial capex low. That's why the financing requirement is materially lower than the capex. And so to me, it's one project. It's one simple project. Open pits, underground. It's all the same style of copper. All processes together. It all works together. It's all lovely. And I think that's the simplicity for it.
Chris, appreciate your time today. Thank you.
Thanks, Matt. Thanks for having me.